Good afternoon, everyone. Welcome to the Trefis webinar on better financial planning. My name is David Levy, and I am the Chief Marketing Officer for Trefis, and I'll be your host for today. Some logistics. You will all be in listen-only mode, but there will be a Q&A session towards the end of the webinar, in about 20 minutes or so. If you have a question during the presentation, you may submit it through the Q&A panel. If you are in full screen mode, click the question mark icon located on the floating toolbar at the lower right side of your screen to open the Q&A panel. Simply type your question into the dialog box and click the send button. If you're in split screen mode, the Q&A panel is already open and is located at the lower right side of your screen. As a reminder, this presentation is being recorded, and we will make the presentation materials available to everyone in a day or so. Finally, joining me is Larry Gorkin, Managing Director for our Solutions Group. You couldn't find a better person to lead a session on business planning than Larry. Larry has a 30-year career as a consultant and line executive at companies such as Procter & Gamble, GE, and McKinsey, and has seen his share of forecasts and business plans, not to mention the processes behind creating them. Now, without further delay, I'll turn this over to Larry.
Thank you, David, and hello, everyone. As you know, today's webinar is focused on helping leaders develop better, more accurate business plans and forecasts. Under this umbrella, we'll cover three main topics. First, why companies miss their forecasts. Second, what you can do about it. And finally, a short bit about how Trefis can help. Before we get started, I thought it would make sense to get a kind of idea from the group of attendees about the nature of this issue inside their company. And so to kick off, we'll just do a very, very quick poll just to get a sense of what's going on at the companies for those attending. This question ought to show up right now on your screen, which is with three choices. So the question is, how big of a concern is forecast accuracy for leaders in your company? Three choices, and you can just pick the one that's most relevant for you is, A, it's always important but not a particularly big issue. B, it's a mid-level issue we've missed on a few occasions and don't want to repeat. Finally, it's a big issue. We have difficulty consistently making accurate forecasts, even if we don't always miss. So we'll give everybody a minute to enter their findings, and then we'll close this up, David, and we'll see what the tally is.
Got a few responses so far. We'll give you 30 seconds or so to respond, if you will, please. Thank you.
What do we got, David?
Okay, very interesting. It looks like we're almost split. Sample says it is a big issue, and there's some issues with consistency. There's one or two who said it's a mid-level issue, but overall it looks like forecasting is on people's radar screens.
So it sounds like, David, what you're saying is we kind of have the barbell. We got a group on each end, and then some folks just in the middle.
Yes.
Yeah.
Absolutely.
Well, that's interesting context. But that's a good grounding for us just about how important this is. And so let's start out with why this subject is important and why it's easier said than done to get better plans. So here's an astounding fact. Each quarter, about 25% of public companies miss Wall Street expectations for earnings or reduce their previously given guidance. That's thousands of companies, not counting privately held firms that we don't hear about. And to be clear, we're not talking about small, no-name firms. Instead, we're talking about big household brands, people like IBM, Macy's, Walmart. It's a huge list. And of course, this would be bad if forecasts were just about scorekeeping. In that case, all you'd have is a big public embarrassment. But in fact, forecasts are decision-driving instruments. Most of the folks on the phone probably realize this. with huge implications inside and outside of the firm. Think about some of the decisions driven by a forecast. Internally, people are making capital spending decisions. They're making salary and compensation decisions. People are being hired. Production is being put in place. Inventory is being built. And then externally, you've got a bunch of people who are acting on what they expect to happen based on the guidance provided. Analysts are making projections. Earnings per share multiples are being developed. People are making stock investments. And of course, the overall price is being driven overall. And so, when a company misses or reduces its forecast, the impact and the ripple can be huge. Salaries and bonuses get cut. People lose their job. Inventory is built up. Profits decline. And millions of dollars in market equity just simply disappears. And in fact, sometimes executives even lose their jobs. I guess the bottom line point here, David, is missed forecasts really destroy value.
Wow, thanks, Larry, for setting the context. Forecasts are indeed important, but Larry, if so many people and so many companies are missing it, why is it so hard to get forecasts right?
Well, on the one hand, David, it's a perplexing question. Most companies have a formal planning process. I'm sure just about everybody on this phone call today, this WebEx, has one. Lots of smart people invest countless hours filling out templates and in meetings discussing numbers and plan. Clearly, it's not for lack of effort. In fact, you have to say the record of accuracy is totally dismal, especially given how much effort and investment is made to get there. And so the question becomes, if people are working so hard, why don't they do better? Well, the fact is, David, it is hard, right? Leaders want plans that optimize companies' market opportunity. They make a forecast too low, and you've left money on the table and created opportunities for competitors. If you stretch too far, you've got the problem we're talking about right here. And of course, more than all of that, you're dealing with forecasting the future, and the future is inherently uncertain. There are specific requirements involving data, tools, and process that companies need to effectively plan for the future. What we've learned is that most companies have gaps in at least one, if not all three of them, and we'll talk about them individually. So the first is the fact that most companies don't have an agreed fact base for what will drive business results in the future. That's not to say that companies aren't working with lots of facts or data. In fact, they probably have too much. But the more specific requirement is to have an objective and agreed measure of which internal and external factors will drive results, and by how much. For example, some businesses may be driven by oil prices, while for others, housing starts may be critical. Every business will be different. Undoubtedly, most companies have intelligent and reasonable ideas for what these factors might be, but what most of them lack is an objectively measured, statistical-based answer for which ones actually count and by how much. Without these facts, you're just guessing. And unless there's concurrence across the leadership team about what the facts are, it's just as bad as not having the facts at all.
Okay, Larry. So the first problem is that companies don't even know which facts to agree on. And as you were talking, I was thinking about the poem, "Water, water everywhere and not a drop to drink." In a world where there's a ton of big data, it seems like we may know even less with all of that data. Is that fair?
In fact, that's a really good characterization of it, David. You know, the fact of the matter is people have so many facts, they think they're really dealing with them. But the fact of the matter is not all facts are created equal. You've got to know which ones count and which ones are most critical and by how much each one will drive your forecast.
Okay, great. What's the next issue, Larry?
The second has to do with the tools and capabilities that companies have to work with. And it's really closely linked to this whole idea of having a foundational fact base. And the issue here is that most companies lack an efficient way to effectively and efficiently create and evaluate potential scenarios around their forecast. Developing a forecast requires executives to test assumptions, ask what if, and look at alternatives. And today, companies really are poorly equipped for this exercise. You might say, so how's this done? And the answer is most companies develop planning models in an Excel spreadsheet.
So it's mostly Excel.
It's mostly Excel. You know, some folks use some other database, but for the primary starting point, you're dealing with some kind of a spreadsheet. But few executives want to crawl through the rows and columns on a spreadsheet, right? Who's going to do that? And so most are presented with a few options that analysts and teams have prepared in advance. But teams can never anticipate the full range of scenarios and questions that executives want to consider. Moreover, because the data is typically presented in static PowerPoint charts, there's no way for executives to taste sensitivities, assumptions, or alternatives in real time. So when unanticipated questions are raised, the question is between adjourning to a later date or making decisions without the data. Neither one of these is really a good option, David.
Larry, the situation you describe really hits home for me. I spent a lot of time in my career making presentations, especially when I was on the agency side. And I'm sure there's some people on the phone who have been in the situation where you've been in the conference room presenting to an executive or the client who comes up with a question that you hadn't anticipated, and everyone kind of stands there and looks at each other nervously, hoping that someone has an intelligent answer to the question, but no one really does. And it's a very awkward situation, which leads to having to reconvene and hem and haw and come back later to answer the question that was asked.
Yeah, well, that's the point, David. It's not that nobody can answer the question. It's just that, okay, right now the question's being raised, and either somebody's going to take 15 minutes to go diving into a model or a spreadsheet, or they're going to go and make a decision without the information, or they're going to postpone the meeting for a week or 2 hours or whatever it is. It's really about having the tools and capabilities to do decision-making in an interactive way. The final issue has really to do with the process. And as the final link here, what we've found is that most companies lack a consistent and disciplined approach for tracking those leading performance indicators and their impact on forecasts. And this gets to the leading indicators that we talked about as the first gap, right? Mm-hmm. It's not to say that companies aren't tracking business results and how they compare versus plan. I can't imagine anybody who isn't, but that's not always helpful or enough. Once business results come in, it's frequently too late to respond. As you think about a year, a company's options to address a forecast or potentially leverage an unexpected strength start diminishing as the year progresses. Executives need the earliest possible headlights when plans aren't going to be met or when new opportunities are presented. But most companies don't have a disciplined or consistent process for doing this.
So by the time, this kind of ties a lot of the input together here about data and information, by the time you find out about something as an executive, it may be too late to do anything, whether it's to take advantage of an opportunity or to address something that has a negative impact on your business.
What we're all about is giving executives the most time possible so that they can act proactively rather than just be managing against a forecast that weren't met. And so, just to recap, right, there are three main issues that are really undermining companies' capabilities. One is the lack of an agreed fact base. Second has to do with the inadequate tools to go and do the scenario analysis. And finally is the incomplete process that doesn't allow people to bring it all together by tracking how the indicators are moving and what the implications would be on their forecast.
Okay, Larry, now you've defined the problem. The question that I have, and I'm sure many of our attendees have, What can you do about it?
Well, it's usually true, David, and folks on the phone, that when you have a problem and it's clear, so does the solution. So let's talk about the steps that people can take. The first is building that fact base. As we discussed, we need to identify and quantify the specific external and internal factors that drive each unit's business results. And we recommend a three-step process. First is to conduct interviews or work sessions with internal stakeholders to identify hypotheses of what the business drivers might be. Remember, we're looking for leading indicators, specific factors that directly influence or closely correlated with changes in future results. Underscore the word future. Examples might be unemployment rates, interest rates, manufacturing output. It all depends on your business. Second, then what we recommend doing is using regression analysis to determine which of those hypothetical factors actually correlate with the business results and what impact or weight each one would have. Finally, you want to vet those results of your modeling with key stakeholders to be sure they kind of pass the sniff test. You need to be sure the output makes sense in the eyes of folks who know the business best. Once you're comfortable that they're right, those factors need to get integrated into the pro forma financial models for the business.
Let me make sure I understand you, Larry. You said something at the beginning regarding the need to interview people, and it took me back to my career as a journalist, which sounds like it's almost like a reporter here. You have to talk to people, you have to investigate, and then when you have that information, you have to analyze it to make sure that the facts are relevant and they're accurate. Is that a decent comparison?
That's a nice way to think about it, David. You know, for most companies, it's hard to imagine that there aren't executives who don't, at a gut level, understand what drives their business. Some of the factors that they identify may be lagging indicators, though, right? Some may not predict the future, but they may be correlated, but not necessarily in a leading way. What we want to do is get all the hypotheses on the table and then just find out, like you said, David, which ones are accurate, which ones are relevant, and how important each one is.
Great.
The second step that people can take is to focus on scenarios. And this is where the art and the science of business planning really come together. The idea is to look at each of the business drivers and determine which scenario is most likely. It's important here for the decision makers and the participants to understand the range of possibilities and what they imply. What risks are important? Which risks are apparent? Which ones do you want to defend against? On the other side, it's what are the potential opportunities and which ones do you want to protect? It's all about testing assumptions and assessing risk and reward. Eventually, you try and get all the stakeholders to align on the scenario that you believe is going to be most likely.
Larry, when you say things like testing assumptions and developing scenarios, the phrase that comes to my mind is playing what if, right? Is that what you're talking about?
That's exactly what I'm talking about, David. When I think about executives and decision making, I always think that most decisions that senior folks need to make come down to two possibilities, two core questions. One is what if, okay, meaning what if something happens, and secondly, compared to what? What are my alternatives? And if you have a process for assessing those different scenarios and options, you're going to get everybody aligned on the forecast that makes the most sense.
Well, that's a great segue into our next topic here.
Yep. The last piece here is all about installing the headlight. This is building that continuous information loop where we track and update your forecast with a link to the underlying performance drivers. The idea here is to continuously track the business drivers and then see the forecast implications. Performance drivers need to be continuously updated so that the business owners can know at any given time what the trajectory is for their results, and then have a disciplined process to evaluate any changes that they want to adopt in their plans. we always recommend that folks take meetings minimally on a quarterly basis and certainly potentially on a monthly basis to discuss the latest updates and next steps. So from our perspective, there are three things that you can do to ensure your company and your team is developing a better forecast. First is to create that fact base, which is all around what's going to drive your business and by how much. Secondly is to create and compare the scenarios around risk and reward, what the future is most likely to look like. And then finally is to create that ongoing loop of information that provides the headlights into where things are actually evolving and what the implications are for your business.
So the three keys to better forecasts are create the fact base, develop scenarios, and install headlights.
Exactly. So naturally, Trefis can add value to this whole area, and we'd like to spend a few minutes sharing with you a little bit more about how we do that. For those not familiar, Trefis is all about helping companies make better decisions and achieve better results in the face of uncertain futures. We do this with a software platform that takes models, data, and analysis and transforms them to a distinct visual format where users can easily create and evaluate alternative scenarios. Trefis technology does this automatically without requiring templates. Trefis kind of works in a very simple three-step fashion, right? You upload your model, it gets transformed into the Trefis format. Users are able to get a link that takes you to the Trefis interactive experience where they can modify their forecast, test out as many scenarios as they'd like, and then you can save and share your scenarios and easily collaborate with your colleagues. And this is where Trefis becomes the glue that pulls the whole process together so that executives can develop more accurate forecasts and plans. First, we take companies' full forecasting models, with those correlated business drivers integrated, and we integrate them into the Trefis interactive format. This enables teams to easily and quickly focus on the key drivers and to create and evaluate scenarios in real time. Stakeholders are able to quickly engage to test assumptions, assess risk and reward, and align on the best possible plan. Second, we automate the whole process for monitoring and tracking. Every month, the Trefis-enabled model is updated with the latest business results and with the most current data for the all-important business indicators. At any given time, executives can link directly into the Trefis model and see the most current results versus plan, including the actual business driver data relative to base assumptions. Executives can quickly create scenarios and assess the risks and rewards with their plan. And finally, what you need is executives to plan, have that process in place, which is to take action based on what they've learned from the continuous monitoring of the business indicators and the implications for their forecast.
So you transform the models. It allows you to do what-if scenarios. The data can be updated in real time, so you can look at it at any point. And then based on your process to review that data, you can determine what actions to take.
Exactly. And so now what I'd like to do, David, is to do a quick demonstration for how Trefis works. And this is meant to be very, very brief. This is just meant to provide a quick demonstration of our capabilities. Anybody who's interested in seeing how Trefis actually works, we can schedule a full demonstration. What you're seeing here is you're looking at a Trefis transform model for the ABC company. Okay, and they're well known, of course, for their line of products of A, B, and C. As we're looking at this, Larry, before we get into it, so this is essentially what happens when an Excel model is transformed.
this is what we get back when you click on the link.
Exactly. You get a link, and you'll get a model that reflects all of the inputs and outputs that are part of your model and that the creator has decided. And right here you see this forecast goes out. We can look at any year all the way out to 2020. And I'm just going to click on product B right here. And what you see is we're peeling the onion, and what we can do is we now see how this model was built up. And again, this is a very simple model. But you see here, this was built based on the price of product B, its market share, and the product market size. And what a user can do to create a scenario right now is we can say, well, what would happen to the forecast if the price of product B declined significantly? And so I'm just going to drag this down. And as you see that, we've knocked a bunch of the earnings, the net income, out of, we've declined the net income by about 2%. The EPS is off by about a penny. The target price is down by about 18 cents. We can go to the next element, which is market share, and we will take a negative view here, and we'll say, well, what would happen if the market share declined, right? So this is kind of a pretty downside scenario. And once again, as we do that, the forecast, all the elements update automatically. And what we can do is we can go through the entire model, adjusting any element in the forecast that we feel like.
Wait a minute. So I think what you just did was the equivalent of someone going into an Excel spreadsheet and finding a particular cell and deleting and changing it and to update the values. Is that right?
That's exactly what we've done, except we're doing it in real time, and we can adjust any of these factors. In real time, we can go and we can deal with cost of goods sold. We can say, if we went to cost of goods sold, we can see exactly what would happen if cost of goods sold went up, right? Which would be more of a negative scenario. Or in this case, actually would drag it down, right? Cost of goods sold went up, I'm sorry. So, and because this is based on margin, so this would be if the margin declined. And what we can do is, in fact, we can click on this and we can create a new, so we're going to create a scenario here. Okay. And we're going to call it a bearish view. And we're going to save that. And we can create as many scenarios in real time as users would like. We can create an upside scenario. People create scenarios around operating metrics, much like we did here, around industry dynamics, around macro events, things like Greek default or oil prices. People can create endless numbers of scenarios in real time, and then they can share those with others because you can provide a link.
I was going to ask you can share those with others. Okay.
Exactly. So this is meant just as a very quick demonstration of how Trefis works in real time.
We're going to go back to our presentation.
I should bring up that we've got a few related capabilities that folks might be interested in, right? Around this whole area of helping companies develop better forecasts. We also help companies who don't have the fact base. We work with the teams to develop the facts and develop the regression analysis and the modeling. What we do is we help the teams identify the hypotheses. We conduct regression analyses to determine which factors actually impact future results. And then finally, we integrate the identified business drivers into the pro forma financial models to create the interactive Trefis model that can be used to create and compare alternative scenarios. So let's wrap up our formal presentation. As we do this, let me just suggest that there are a couple of next steps that you can do here. First is to take action. The first thing that you can do is we'll be sending out slides from today's presentations, and you should review those. You should take steps to evaluate your process and capabilities. And finally, identify what gaps you have and address those.
All right, everyone. If you have a question, you can enter it in your Q&A panel, which you'll find on your WebEx screen. It looks like we have I have a couple here, Larry. Let me read you the first one. Can you talk more about how to identify the performance indicators? Our company doesn't know what they are and doesn't have a model. Here's someone who doesn't even have a model or know what the indicators are. So what do they do?
Yeah, well, let me say, first of all, I doubt that company doesn't know what they are. They may not have kind of formalized them, but most companies have a bunch of wisdom in the executives who are running the business day to day. People who are frontline with customers, folks who have been working at doing financial forecasts for years. So there are folks who probably know more than they think. What they may not have done, though, is really figured out which ones are important and which ones aren't. And so that's why we start out by getting a collection of the best hypotheses and then using the regression analysis to develop which ones are the real ones that matters and people should pay attention to them. The process of quantifying and doing the regression analysis, that's kind of bread and butter stuff for an analyst who knows how to do it. The magic is figuring out what to put in that regression modeling so that you're factoring in and out the right issues.
So that's that interview process up front we talked about. Okay, here's another one, kind of the opposite. We have all of our models in Excel. What's the extra value of using Trefis? Seems to be saying things work just fine in Excel. Why would I need to work with Trefis?
Well, in fact, there is really nothing you can't do that Trefis can do that you can't do on your own. In fact, sheer muscle can get you through anything. The real value, though, is making the data and the models more accessible to the decision makers. So while you may have some great spreadsheet jockeys who really are pretty good in the model and who are very good in facilitating how to work with it themselves, it's very difficult for most executives. They don't have the patience or the desire to actually get to that level of interaction. And you can't do it in real time. And what you saw here is the ability of Trefis to bring to life the models in real time, where you can sit around a conference table or work independently. No need for the model owner to even be in attendance.
You could do this virtually, it seems like.
People do this. They share links, and somebody in Europe is working during their daytime while somebody in the United States is sleeping, and they share and compare scenarios and what they've learned from it.
That's great. One or two more looks like we have. We talked about the business drivers always being up to date. How does that work?
Well, so depending on what your business drivers are, David, they get updated, right? If you're following oil prices change daily. If you're looking at manufacturing output or consumer confidence data as a driver, those get updated on a monthly basis. Some of them are quarterly updates. So what we do is we take those data feeds and just put them into the model. We just load those updated performance indicators into the model, and then the model through Trefis automatically, the transformed Trefis model automatically updates. Any given time, somebody puts on the link, whether it's the beginning of the month or the end of the month or the next month, they're seeing whatever the most current data is.
We have a question here about Trefis again. How does it work? Is it software that we have to install on our servers?
No, in fact, Trefis is cloud hosted, and so we don't go into anybody's data center at all. And in fact, it works through a secure hosted web link where everybody has a personal approved user account. They're able to log into a secure FTP. The models get loaded through the web in the same way, so it allows for people to have access to Trefis anywhere they are, and nobody has to get involved with IT, getting things on servers. Nobody we know in today's world has enough, bandwidth in their IT organization.
Right. Okay. Well, terrific. Well, we've got a little bit of time left over, but we can be generous and give people back a quarter of an hour. We want to thank everyone for attending today's webinar. It will be recorded, and we will post it to our website, and we will send out a link to it, and we will make available the presentation you saw today. In the meantime, if you have any questions, we invite you to contact us directly. You see our email addresses on the screen right now. And you can always go to trefis.com to see our offerings. And in particular, you'll see our planning and forecasting solution described underneath our Solutions tab. So thank you very much, everyone, and have a terrific day. Bye-bye. One or two more, looks like we have. We talked about the business drivers always being up to date. How does that work?
Well, so depending on what your business drivers are, David,